Credit card fraud is a wide-ranging term for theft and fraud committed using or involving a payment card, such as a credit card or debit card, as a fraudulent source of funds in a transaction. The purpose may be to obtain goods without paying, or to obtain unauthorized funds from an account. Credit card fraud is also an adjunct to identity theft, according to the United States Federal Trade Commission. While identity theft had been holding steady for the last few years, it saw a 21% increase in 2008. However, credit card fraud, that crime which most people associate with ID theft, decreased as a percentage of all ID theft complaints from the sixth year in a row. Although incidence of credit card fraud is limited to about 0.1% of all card transactions, this has resulted in huge financial losses as the fraudulent transactions have been large-value transactions. In 1999, out of 12 billion transactions made annually, approximately 10 million, or 1 out of every 1,200 transactions, turned out to be fraudulent. Also, 0.04% of all monthly active accounts were fraudulent. Even with tremendous volume and value increase in credit card transactions since then, these proportions have stayed the same or have decreased due to sophisticated fraud detection and prevention systems. Today's fraud detection systems are designed to prevent 1/12% of all transactions processed, which still translates into billions of dollars in losses. In the decade to 2008, general credit card losses have been 7 basis points or lower. In 2007, fraud in the United Kingdom was estimated at £535 million. Initiation of a card fraud. Card fraud begins either with the theft of the physical card or with the compromise of data associated with the account, including the card account number or other information that would routinely and necessarily be available to a merchant during a legitimate transaction. The compromise can occur by many common routes and can usually be conducted without tipping off the cardholder, the merchant or the issuer, at least until the account is ultimately used for fraud. A simple example is that of a store clerk copying sales receipts for later use. The rapid growth of credit card use on the Internet has made database security lapses particularly costly in some cases. Millions of accounts have been compromised. Stolen cards can be reported quickly by cardholders, but a compromised account can be hoarded by a thief for weeks or months before any fraudulent use, making it difficult to identify the source of the compromise. The cardholder may not discover fraudulent use until receiving a billing statement, which may be delivered infrequently. Cardholders can mitigate against this fraud risk by checking their account frequently to ensure constant awareness in case there are any suspicious, unknown transactions or activities. Stolen cards. When a credit card is lost or stolen, it may be used for illegal purchases until the holder notifies the issuing bank and the bank puts a block on the account. Most banks have free 24-hour telephone numbers to encourage prompt reporting. Still, it is possible for a thief to make unauthorized purchases on a card before the card is cancelled. Without other security measures, a thief could potentially purchase thousands of dollars in merchandise or services before the cardholder or the card issuer realizes that the card has been compromised. The only common security measure on all cards is a signature panel, but, depending on its exact design, a signature may be relatively easy to forge. Some merchants will demand to see a picture ID, such as a driver's license, to verify the identity of the purchaser, and some credit cards include the holder's picture on the card itself. In some jurisdictions, it is illegal for merchants to demand cardholder identification. Self-serve payment systems are common targets for stolen cards, as there is no way to verify the cardholder's identity. There is also a new law that has been implemented that identification or a signature is only required for purchases above $50, unless stated in the policy of the merchant. This new law makes it easier for credit card theft to take place as well, because it is not making it necessarily for a form of identification to be presented. So as long as the fraud is done at what is considered to be a small amount, little to no action is taken by the merchant to prevent it. A common countermeasure is to require the user to key in some identifying information, such as the user's zip or postal code. This method may deter casual theft of a card found alone, but if the cardholder's wallet is stolen, it may be trivial for the thief to deduce the information by looking at other items in the wallet. For instance, a U.S. driver license commonly has the holder's home address and zip code printed on it. Visa Inc. offers merchants lower rates on transactions if the customer provides a zip code. In Europe, most cards are equipped with an EMV chip, which requires a 4 to 6-digit PIN to be entered into the merchant's terminal before payment will be authorized. However, a PIN isn't required for online transactions, and is often not required for transactions using the magnetic strip. However, magnetic strip transactions are banned under the EMV system. In most European countries, if you don't have a card with a chip, you'll usually be asked for photo ID, e.g., national ID card, passport, etc. At the point of sale, many self-service machines require a PIN and chip in EMV land. Requiring a customer's zip code is illegal in California, where the state's 1971 law prohibits merchants from requesting or requiring a cardholder's personal identification information as a condition of accepting the card for payment. The California Supreme Court has ruled that the zip code qualifies as personal identification information because it is part of the cardholder's address. Companies face fines of $250 minus $1,000 for each violation. Requiring a personal identification number may also be a violation. Card issuers have several countermeasures, including sophisticated software that can, prior to an authorized transaction, estimate the probability of fraud. For example, a large transaction occurring a great distance from the cardholder's home might seem suspicious. The merchant may be instructed to call the card issuer for verification, or to decline the transaction, or even to hold the card and refuse to return it to the customer. The customer must contact the issuer and prove to to get their card back. In Australia, there is a service called PayPass, or more colloquially known as Tap and Go. This is where a person can purchase goods or services and can just tap the credit card on the card reader. If the transaction is less than $100, no PIN or signature is required. A stolen credit or debit card could be used for a significant amount of these transactions before the true owner can have the account cancelled. Compromised accounts. Card information is stored in a number of formats. Card numbers, formerly the primary account number, are often embossed or imprinted on the card, and a magnetic stripe on the back contains the data in machine-readable format. Fields can vary, but the most common include name of cardholder, card number, expiration date, verification, CVV code, card not present transaction. The mail and the internet are major routes for fraud against merchants who sell and ship products, and affects legitimate mail order and internet in merchants. If the card is not physically present, the merchant must rely on the holder presenting the information indirectly, whether by mail, telephone, or over the internet. While there are safeguards to this, it is still more risky than presenting in person, and indeed card issuers tend to charge a greater transaction rate for CNP because of the greater risk. it is difficult for a merchant to verify that the actual cardholder is indeed authorizing the purchase. Shipping companies can guarantee delivery to a location, but they are not required to check identification, and they are usually not involved in processing payments for the merchandise. A common recent preventive measure for merchants is to allow shipment only to an address approved by the cardholder, and merchant banking systems offer simple methods of verifying this information. Before this and similar countermeasures were introduced, mail order carding was rampant as early as 1992. A carder would obtain the credit card information for a local resident and then intercept a delivery of the illegitimately purchased merchandise at the shipping address, often by staking out the porch of the residence. Small transactions generally undergo less scrutiny, and are less likely to be investigated by either the card issuer or the merchant. CNP merchants must take extra precaution against fraud exposure and associated losses, and they pay higher rates for the privilege of accepting cards. Fraudsters bet on the fact that many fraud prevention features are not used for small transactions. Merchant associations have developed some prevention measures, such as single-use card numbers, but these have not met with much success. Customers expect to be able to use the credit card without any hassles, and have little incentive to pursue additional security due to laws limiting customer liability in the event of fraud. Merchants can implement these prevention measures but risk losing business if the customer chooses not to use them. Identity theft. Identity theft can be divided into two broad categories: application fraud and account takeover. Application fraud. Application fraud takes place when a person uses stolen or fake documents to open an account in another person's name. Criminals may steal documents such as utility bills and bank statements to build up useful personal information. Alternatively, they may create fake documents. With this information, they could open a credit card account or an account in the victim's name, and then fully draw it. Account takeover. An account takeover occurs when a criminal poses as a genuine customer, gains control of an account, and then makes unauthorized transactions. According to Action Fraud, fraud is committed at the point money is lost. The most common method of account takeover is a hacker gaining access to a list of usernames and passwords. Other methods include dumpster diving to find personal information in discarded mail, and outright buying lists of fulls, a slang term for full packages of identifying information sold on the black market. Skimming. Skimming is the crime of getting private information about somebody else's credit card used in an otherwise normal transaction. The thief can procure a victim's card number using basic methods such as photocopying receipts, or more advanced methods such as using a small electronic device to swipe and store hundreds of victims' card numbers. Common scenarios for skimming are restaurants or bars where the skimmer has possession of the victim's payment card out of their immediate view. The thief may also use a small keypad to unobtrusively transcribe the 3 or 4-digit card security code, which is not present on the magnetic strip. Call centers are another area where skimming can easily occur. Skimming can also occur at merchants such as gas stations when a third-party card-reading device is installed either outside or inside a fuel dispenser or other card-swiping terminal. This device allows the thief to capture a customer's card information, including the PIN, with each card swipe. Instances of skimming have been reported where the perpetrator has put over the card slot of an ATM a device that reads the magnetic strip as the user unknowingly passes the card through it. These devices are often used in conjunction with a miniature camera to read the user's PIN at the same time. This method is being used in many parts of the world, including South America, Argentina, and Europe. Another technique used is a keypad overlay that matches up with the buttons of the legitimate keypad below it and presses them when operated, but records or wirelessly transmits the keylog of the PIN entered. The device, a group of devices illicitly installed on an ATM, are also colloquially known as a skimmer. Recently made ATMs now often run a picture of what the slot and keypad is supposed to look like as a background, so that consumers can identify foreign devices attached. Skimming is difficult for the typical cardholder to detect, but given a large enough sample, it is fairly easy for the card issuer to detect. The issuer collects a list of all the cardholders who have complained about fraudulent transactions, and then uses data mining to discover relationships among them and the merchants they use. For example, if many of the cardholders use a particular merchant, that merchant can be directly investigated. Sophisticated algorithms can also search for patterns of fraud. Merchants must ensure the physical security of the terminals, and penalties for merchants can be severe if they are compromised, ranging from large fines by the issuer to complete exclusion from the system, which can be a death blow to businesses such as restaurants where credit card transactions are the norm. Checker is a term used for a process to verify the validity of stolen card data. The thief presents the card information on a website that has real-time transaction processing. If the card is processed successfully, the thief knows that the card is still good. The specific item purchased is immaterial, and the thief does not need to purchase an actual product. A website subscription or charitable donation would be sufficient. The purchase is usually for a small monetary amount, both to avoid using the card's credit limit, and also to avoid attracting the card issuer's attention. A website known to be susceptible to carding is known as a cardable website. In the past, carders used computer programs called generators to produce a sequence of credit card numbers, and then test them to see which were valid accounts. Another variation would be to take false card numbers to a location that does not immediately process card numbers, such as a trade show or special event. However, this process is no longer viable due to widespread requirement by Internet credit card processing systems for additional data such as the billing address, the 3 to 4-digit card security code and/or the card's expiration date, as well as the more prevalent use of wireless card scanners that can process transactions right away. Nowadays, carding is more typically used to verify credit card data obtained directly from the victims by skimming a phishing set of credit card details that has been verified in this way is known in fraud circles as a phish. A carder will typically sell data files of the phish to other individuals who will carry out the actual fraud. Market price for a phish ranges from $1 to $50 depending on the type of card, freshness of the data and credit status of the victim. Bin attack credit cards are produced in bin ranges, where an issuer does not use random generation of the card number. It is possible for an attacker to obtain one good card number and generate valid card numbers by changing the last 4 numbers using a generator. The expiry date of these card IDs would most likely be the same as the good card. Phishing scammers may use a variety of schemes to lure victims into giving them the card information through tricks such as websites pretending to be a bank payment system. Telephone phishing can also be employed, in which a call center is set up to pretend to be associated with a banking organization. Balance transfer checks and promotional offers include active balance transfer checks which may be tied directly to a credit card account. These are often sent unsolicited, and may occur as often as once per month by some financial institutions. In cases where checks are stolen from a victim's mailbox, they can be used at point-of-sales locations, thereby leaving the victim responsible for the losses. They are one path at times used by fraudsters. Unexpected repeat billing. When a cardholder buys something from a vendor and expects the card to be charged only once, the vendor may charge the card a small amount multiple times at infrequent intervals such as monthly or annually until the card expires. The vendor may state in the fine print that the customer is now a member, and the membership will be renewed periodically unless the cardholder notifies the vendor in accordance with a cancellation procedure in the membership agreement which the cardholder agreed to when they made the initial purchase. Because the periodic charges are unexpected, infrequent, and small, most cardholders will not notice the charges. If a cardholder complains to the bank that the charges were unauthorized, the bank will notify the vendor of the disputed charges and the vendor will respond that the cardholder never cancelled the membership which the cardholder agreed to. Since most cardholders have no idea what the cancellation procedure is and the vendor will reveal it only to new customers, the bank will not reverse the charges, but instead will offer to cancel the credit card and reissue it with a different account number or expiration date. Unexpected repeat billing is in a gray area of the law, depending on whether the customer legitimately agreed to the charges. Online bill paying or internet purchases utilizing a bank account are a source for repeat billing known as recurring bank charges. These are standing orders of bankers' orders from a customer to honor and pay a certain amount every month to the payee. With e-commerce, especially in the United States, a vendor or payee can receive payment by direct debit through an automated clearing house. While many payments or purchases are valid, and the customer has intentions to pay the bill monthly, some are known as rogue automatic payments.